Hey folks, I've come to realize that many of you may be new to investing in the stock market. So today I wanted to take a moment and explain to you 3 things that every investor needs to know, whether you're seasoned or you're brand new, because the first thing is going to give you a direction, almost a moral compass in what you should be doing with your capital. The second is how you're actually going to value a stock, and I'm going to lead you down the path of least resistance to not losing money in the stock market with some very simple tidbit advice that'll kind of clear up any confusion you have about just valuing a stock. And then finally, we need to talk about how you keep that money and, try and keep Uncle Sam's hand out of your pocket, folks. So in the clarity of my transparency and all the wonderful homework I do for you beautiful buggers out there, consider hitting that like button, folks, and let's get right into this. I started with numero uno, what Albert Einstein called one of the 8 wonders of the world, and this is the beautiful understanding of compound interest and how little bits become lots of bits over a long period of time. And we use compound calculators to understand where we are, where we're going, and we can do little fine adjustments to figure out how we can change the trajectory of our future outcome here, guys. So let's start off with a very simple example. You're brand new to investing, guys, and maybe you're able to put $500 away a month, or the equivalent of $6,000 annually. Now let's presume maybe you're 30 years old, you're just starting out, and you plan on retiring by the time you're 60. That means you've got about 30 years of investing ahead of you. We plug that in, guys, and now we have to look at the interest rate, okay? The safest investments many of us are aware of are what they call broader index funds, something like an S&P 500, which represents the 500 largest companies in the US. Now, the historical rate of return of this has been around 10 to 12%, but over the last 5 years, it's actually been historically much higher. It's been about 18 to 20%, but just to keep this at a relative median, just to give us a baseline, let's say that we're gonna get a return of about 10%, being very modest here, okay? That means in over the 30 years, by the time we reach retirement age, we'll have very close to $1.1 million. But let's say circumstances are drastically different between what you want and what I want, because I want to retire before I'm 40 years old. So let me show you my circumstances, as I have about $250,000, a little more than that, but we'll say $250,000 invested in the market. Let's say I'm going to be a lot more aggressive about my investing style, and I'm going to be putting away about $1,000 a month, or roughly $12,000 a year here, guys. Now, I want to grow this over the next, I'm 29 years old now. I want to do this, let's even cut the time down even shorter. Let's say I want to be doing this for the next 6 years until I'm 35 years old. So let's say, yeah, my time horizon is going to be 6 years. Now, knowing this, I need to get a higher compound rate of return if I wanted to reach, say, that $1 million mark. And fortunately for me, though I don't use this as a baseline because there's no way to guarantee it continues to move forward, but over the 7 years I've been investing in the stock market, I have achieved a rate of return of around 30% here, folks. And if we calculate that out, that means just in the next 6 years, it is very likely that I could have 1.4 million. But let's presume I don't get that likely. Let's presume I end up getting a market average return of 10%. Where am I likely to end up? Well, about $500,000. You can play around with this in many different directions by obviously maybe even lowering the contributions here. Let's say I want to invest for a little longer, maybe over a decade, and I'm only going to put away $500 a month, and I'm only going to get 10%, guys. I'm still going to end up in a very decent position with over $700,000 before I'm 40 years old at that rate. So we can see how just sitting here, guys, we can get a very good direction from our own personal circumstances, because what I'm going to try and do might not be what you want to try and do, and this is how you're going to figure out how you're going to be investing your money. Because if you want to fast track your financial independence, you might have to take on a little bit more risk than the average investor to get your interest rate up. Or heck, maybe you're in a circumstance where you make a lot of money and you don't want to have to worry as much about your investments, so you're going to put it somewhere safer, but you're going to put a lot more away a year, so maybe you don't need as high of an interest rate. You can get a lower interest rate and still make an incredible return. So I'm going to leave the link to this in the description below. So let's move on to numero dos, the next most important thing new investors have to understand, and that is, how do we value a stock? Now, there's no way I can do this in a quick 5 minutes, but I'll give you an example of a few things I look at that will literally drastically change whether you're going to make money or not. Let's use one of my favorite stocks as an example here. Let's talk about Facebook, right? Now, Facebook is something that I believe is a good investment. How do I decide that off very simple metrics? We're going to go into Yahoo Finance, guys. If you look up Yahoo Finance and you type in Facebook, and maybe we'll just do this from scratch just to show you guys exactly what I'm doing here. Scroll down as it loads, and we want to go into the financials here, guys. This is where everything we're going to want to know is. We go into the financials, we'll see that it'll bring up the income statement, and what we want to do is hit the balance sheet And what we can see here, guys, one of the first metrics and one of the most important metrics to look at is the total assets here minusing the total liabilities. If the liabilities is a bigger number than the total assets above it, that is a big red flag. That means if that company went bankrupt tomorrow, they actually owe more money than they actually have in their pocket. This is like a millennial that has too much on a credit card and no cash to pay it off. That is not what you want your company to be operating like. And we can see Facebook has only 31 billion in liabilities, but they have 160 billion dollars in assets. So if you minus everything they owe, guys, they are sitting on roughly 130 billion dollars that they could plop in their hands in cash if they wanted to. And if we scroll down, instead of me saying, hey, I want you to go through all the numbers on this balance sheet, luckily Yahoo Finance gives us this wonderful little bar chart here, guys. And if any company you are buying, you want to see the blue and the green line going this way. You want them going up, guys, up and to the right, baby. You don't even have to really care about the numbers. So long as they're going up and to the right here, folks, and they have more assets than liabilities, it's pretty hard to lose money, in my opinion. But we also want to make sure we're not overpaying for a company. So how do we do that? Well, what I recommend doing is go into what they call the statistics here, guys. And if we scroll down, they have what is called a trailing PE and a forward PE. This is one of the most important metrics. When we look Facebook up on Google, we can actually see that it shows a PE ratio of 26. What does this mean? Well, the PE ratio is what we call the price to earnings. So let me take a moment and explain to you how the price to earnings multiple works as though I was talking to a child, guys. So you have something like Facebook that is going to make a ton of money this year. Now, after they pay all of their taxes and their debt liabilities, they're going to end up with what is left over that me being a shareholder, some kind of entitlement to here, folks. And if the company is trading what they call a price to earnings, in Facebook example here, of 26, that means that the company doesn't grow its revenue and it doesn't lose any revenue and everything stays flat. That means it would take 26 years of their earnings capability for me to make a 100% return on my invested capital. And historically, this is a very high PE ratio. And anytime you're buying a growing company, the PE ratios will get larger and larger. And the best way to know that we are not overpaying for a company against what its future growth might look like is going into the statistics here, guys, and looking at that forward PE. Because we can presume if Facebook can keep growing the revenues the way they're growing it based off that chart that we looked at, guys, their forward PE going into this year will be knocked down by 20 or 30% because then we'll only be paying a 20 times multiple. And then let's skip out another 3 to 5 years, presuming, Facebook's going to keep growing at a 20 to 30% rate. Facebook's PE from today can go from 26 all the way down to really 5 or 10. This is presuming you think Facebook's going to continue to grow at that rate here, folks. So putting that aside, let's talk about what is a bad investment then. How can we recognize what's good from what's bad? Well, let's use GameStop as a prime example here, folks. These are the kind of stocks we hear everybody and our grandmother talking about. Heck, we see it on the news a lot, and it drives us to think that we could make a lot of money in this company when we see it run up, 707%. But this is when intelligence has to overcome emotions. Say, hey, this thing's running really fast. Everyone's talking about it. It might be hype. Maybe I don't day trade, and I'm not going to have the cognitive ability to buy in and out of this and actually make a profit. So I'm going to let logic turn on and say, hey, if I actually go into GameStop and we take a look at what we just talked about, the total assets minus the total liabilities, do they have a positive underlying asset? Yeah, but not really by much. And if we scroll down here, guys, to the very bottom to say, is this chart having an uptrend? Actually, it's not. Actually, the green line is going down and the earnings aren't even in the positive. In fact, this company has been losing money year over year. And if we take a look at the PE, it actually goes into the negative. It doesn't even have a positive forward PE, which means this company is projected to continue losing money into the future, which makes a light bulb go off in your head and say, hey, from basically everything we just learned, likely this company is not going to be doing well, even with all the hype. These are the type of investments we need to get afraid of, but because they're so socially interesting, people are willing to gamble like they're going into a casino and somehow think that it is different. Though these are just very few valuation metrics, if these are the only valuation metrics you pay attention to, I promise you it's going to be very hard to lose money investing in the stock market if you have a long-term perspective and a long-term time horizon. And then finally, folks, before we dive down into this last crucial tip that will save you a ton of money. I just want to say, heck, if you want to support the channel, I want to offer you 10 times the value I ask in return. And me and my business partner put together these custom portfolio tracking spreadsheets that allow you to pay attention to your asset allocation, which is so important to make sure you're not putting all your money in GameStop and that you got some extra capital for your ETFs that are going to ensure your long-term future and retirement. This is how I personally track my portfolio, and you only have to buy one of them to get all of them, guys. And heck, even use coupon code Passive Income Investor and you're going to get 15% off. But putting these fun little tools aside, guys, we have to talk about what always seems as very boring, but I'm going to give you a real world example of how I take advantage of taxes. So this is going to be drastically different from if you live in Europe, the US. I'm from Canada here, guys, but you really need to understand your tax laws surrounding your investments in the stock market. So for my personal circumstance in Canada, we have what is called a regular brokerage account, which I get taxed on capital gains and dividends, just like you would in the States or probably Europe. Then we have two tax advantaged accounts. One is called a tax-free savings account, which is where I make money, I pay tax on that money, and then once it's in this account, it's sheltered from paying any tax on income that it generates. So if I make capital gains or dividends, I'm now not paying any tax on that. And then we have what is called an RRSP, a registered retirement savings plan account. Now this account, when I put money in it, I don't have to pay any tax on that money initially up front, and then it can generate money tax-free on capital gains and dividends, and then I'll pay tax when I pull that money out of that account, usually toward retirement. I always recommend that if you're Canadian, start by investing in a tax-free savings account, because though you're paying taxes up front, once that money's in that account, it generates tax-free income that you can actually pull out whenever you want at no tax burden after the fact. I'm just throwing this out here as a simple example because taking a look at my tax-free savings account, this account over the last 4 years is trading up 118%. It is worth about $140,000, which means over $70,000 has all been capital gains and dividends. And if we took that $70,000 in gains in Canada, the government usually taxes half your investment gains. So let's presume on that $70,000, 35 of that thousand is going to be taxed at my marginal income rate, which is going to be around 20 or 30%. So we can presume that the government would have taken somewhere between $10,000 and $15,000 of the money that has been generated in this account if it wasn't in this account specifically. Now, I know this is very confusing and obviously very segregated depending on where you live, but I highly suggest you sit down and you talk with an accountant, or you just go on Google and really spend a good amount of time understanding these different accounts, guys. And if we could save that extra $10,000 and we plug this into our compound calculator, guys, and you are as fortunate as I am to get a 30% rate of return and that continues moving forward, this is how much money I would miss out on over the coming decade just by having that $10,000 and not even investing any more capital. That could turn into $137,000. This is why it is so crucial to understand that these little incremental differences from tax income to just using these tax advantage accounts can really balloon into huge amounts of capital if done correctly. So in light of all of this, I really hope you guys learned something, and I pass the question off to you. What do you think about all this in that comment section below? Did you learn something? Is there something that I missed that you could share with us that could help the greater community? I'd love to hear about it, but stay cool, stay awesome, and I look forward to catching you tomorrow.